market trends and forecasts, outlook for buyers and sellers, key insights from the experts. Welcome to the Hawaii Housing Report with economist Paul Brewbaker and Patrick ONeill.
And I'm Patrick ONeill, principal broker at Luxury Homes International, and joined by Hawaii's favorite economist, Mr. Paul Brewbaker. Paul, how are you?
Aloha.
Good to see you again. Wanted to tell you how much I enjoyed, I'm pulling it up on the screen here, the presentation 2 weeks ago at the mid-year real estate review at Waialae Country Club. Big success. It was fun to see all the people that were there that day, and I really wanted to thank especially the platinum sponsors, Ward Village, Aaliyah, Castle Cook, Luxury Homes, as well as our other sponsors, Guaranteed Rate, Inspect Hawaii, TG, and Hawaii International Real Estate Council. And Paul, thanks for
thank you.
thanks for participating in that. That was our 14th year. So next year's our big one. If you want to get me a present, I'm open to. So
quinceañera.
yeah, there we go. So
oh no, that's 16. No, 15.
Yeah, you're gonna lose me on that one. All right. So there was something you brought up at the mid-year real estate review that I had not heard or seen the data on before, which was what is happening in Maui right now. And I talked to one of my colleagues, Rhonda, today, who's in Kihei, and she was saying exactly what you were saying. And I was wondering if we could start today and you could share some of that data as far as the visitor counts and the economy.
Well, just as backdrop, you have to understand how crazy, we all know how crazy the world is in which we live. Like now we know that Chinese artificial intelligence bots were making TikTok videos and other disinformation content to sow discord and in the wake of the Lahaina wildfires. I mean, who does that? But that's the world we live in. And there's a story in the Honolulu Advertiser early this week, a story over the weekend. David Sanger wrote a piece in the New York Times if you want to check out what's going on with the Chinese bots. But we live in an informationally asymmetric environment. Anyway, so the simple version of it, the local buggers know more about what's happening in their hood or in their island than the Malihini guys that aren't from there. And so it's really easy for bad information to drive out good. You'll remember the East Rift eruption on the Big Island, which a lot of people, got into their heads as enveloping the entire island. This was a meme that was floating around. Now, this is a joke, but as with many jokes, there's an underlying truth that it really spoke to, that people hear volcano and Big Island and they cancel their trip. And people in Kona are going, wait. The volcano's on the other side of the island. It's the biggest island. All the other islands fit into the Big Island with land left over. So we're, anyway, so the same thing ended up happening on Maui, where you had a horrific and tragic catastrophic wildfire in Lahaina, West Maui, as a community and a regional economy has had to shut down. The tourism sector, about half of Maui's visitor plant, if you look at lodging capacity, has had to shut down now for more than a month. But that doesn't mean the rest of Maui can't accommodate visitors or the business that comes from them. Unfortunately, the messaging, initially after the fire at least, said, don't come to Maui, period. And so we have what we have, which is a drop in visitor days that compares to the pandemic experience. Now, this is the pandemic experience for Maui visitor days, arrivals, times, length of stay. These are monthly data. So we don't have, these are quarterly data. So we don't have the August Maui data yet. We don't have the third quarter Maui data yet, but we will. But just to give context, Maui was on a roll pre-COVID, the pandemic hit, and even after the pandemic, Maui was running about 1 million visitor days short of the trajectory it had been on pre-pandemic, which translates at a little over $250 per day, per visitor day, to about $1 billion short of its potential, right? The potential to earn $7 billion instead of $6 billion per year. And if you detrend the data, you can see, how far away relative to trend. Now, another reminder, these variants and subvariants of the COVID virus have also been throttling the recovery from time to time. It's gotten better, but they've been an issue. And the outcome for jobs is even worse. Now, these are pre-wildfire because, again, we still don't have the August Maui employment data. But even before the wildfire, not only had tourism not gone back to pre-pandemic trend, jobs were well below not just where they left off in 2018, 2019, but well below the trend that they would have stayed on had we not disconnected. There's a whole nother set of questions why Hawaii in general, why Maui disconnected in the late 20 teens from the path that it was on previously. We do, however, have daily passenger counts. So these are daily passenger arrivals in Maui that I've converted to weekly data so I can do a little seasonal adjustment. And again, you see the path we were on, the COVID shutdown for 6 months, essentially the restart for tourism with pre-flight testing, and then these various waves of COVID variants, the Alpha variant, the Delta variant, Omicron, BA.4, BA.5 last summer, which had an impact. And you can see that passenger counts were struggling to get back and stay back on trend, but they've been impaired by the variants. And then comes the wildfire. And these are the data through about a week ago, through September 8th, it's the 14th as we record this. And you can see that the initial impact, was maybe 3/4 or 80% of the pandemic impact. So, nearly as large as the mother of all tourism shutdowns. Coming back gradually as people realize the rest of Maui is open. But of course, the damage has been done to not just tourism related businesses, but all manner of businesses, people being furloughed and laid off and, not making their mortgage payment for September or maybe, they'll miss in October. I mean, some real, if indirect, adverse impacts of not just the wildfire, but the misinformation, confusing destination Maui as a whole with the heavily affected areas in West Maui subject to catastrophic
So
damage.
this
Now,
is this is exactly the message right now. Uh, Not being in Lahaina, but being in other parts of the island, just what you said, there are businesses shutting down. There's golf courses shutting down. All those employees,
exactly,
the
exactly.
hotels out there.
Now
Yeah.
I have worked. I haven't worked on this for a week, but last week I was noodling around with what looked to be, just sort of projecting from the first few weeks, right? The message was garbled. The first message was don't go to Maui, and then the message was revised. The problem is nobody hears gets the nuance. I mean, we have West Maui. We mean West Maui. You can still come to South Maui, but if you assume relatively optimistically a return to something that's maybe 80 or 90% of where we were before the fire. And by the way, before the fire, Maui was below where it was in the fall of 2022 on a seasonally adjusted basis. So there's some issues that have to do with, as I mentioned earlier, it's not so much the pandemic legacy as the revenge travel impulse of 2022, late 2021, early 2022, looks more and more like it was a transitory impulse. It was just a one-time, everybody got out of their
Understood.
system.
Okay.
But we'll climb back out. Maui will climb itself back out of the hole maybe over the next few months. The problem is there's maybe 300 million a month over 2 months net, right? We may see some gains in coming months that
Yeah.
offset earlier losses, and then you have the big loss here in August, September. So,
Yeah.
what are you going
Thank
to
you.
do? Support
Yeah.
people as best you can, but
Yeah. And thank you for sharing that. And there's many great organizations. We've been supporting the Realtor Association of Maui Community Foundation, if anyone's still looking for a place to contribute. So, well, Paul, thank you very much for that. Let's take a quick break. We come back, a lot to talk about, especially the inflation numbers, what's happening with interest rates, and some surprising statistics in the housing market. So stand by, I'll be right back with economist Paul Brewbaker. Okay, we're back with economist Paul Brewbaker. Paul, let's shift gears and let's take a look at the inflation rate. The inflation numbers were released recently. We saw the headline rate increase or decrease slightly. The Fed's meeting next week. I wanted to get your take on it all. Where are we in this situation? Is inflation trending down? Are we trending up? Seems like there's a little bit of mixed signals.
Right. So no, the trend is downwards. I know, if it bleeds, it leads. So the news is that the so-called headline rate, which includes food and energy costs, which tend to have, short-term transitory impulses passing through. The rise in oil prices and gasoline prices this summer has now shown up in the August Consumer Price Index as a little higher U.S. inflation. And so that's the headline. Literally, that's been the headline in the wake of the report published yesterday and preceding the Fed's meeting, monetary policy making meeting next week. But this is the actual page from the Bureau of Labor Statistics who published the data. But these are the core rates, core meaning inflation without food and energy costs. And you can see this trend this year to date from 5.5, and now in the last few months settling to 4.5. You can imagine it going to 3.5% over the next 3, 4, 5, 6 months. And the Fed's goal, of course, is 2% measured by the personal consumption expenditure deflator, which in the case of the Consumer Price Index would be 2.5%. They're different measures, so one tends to run a little higher. But contrast just the last year, there's last year's inflation rates around 6%, 6.5%. Contrast with any of the years right up until the early part of 2021, when, 2, we used to joke about it, right? 2 is the number.
And the
number is
2.
2.
Yeah.
And so this has been a very brief but unsettling explosion of inflation, partly associated with supply chain disruptions and the restart of the global economy after the pandemic, but partly associated with strong demand or resilient demand that was supported by federal fiscal stimuli and by a low interest rate policy until that changed. Now we very quickly have rotated to a moment where the fiscal stimuli are gone and the monetary policy makers have raised the interest rate dramatically, more than at any point in the last 30, 40 years. Fortunately, we don't see a sudden stop in economic activity, and therefore the disinflation, the subsidence, is unfolding only very gradually, maybe not as quick as some of the financial market participants would like, or headline writers in the newspaper. But I think enough to lead the Fed next week, I would speculate, to leave its target interest rate unchanged when it meets on Tuesday and Wednesday.
Well, let's bring in Anders Hostelli from Guaranteed Rate here in Hawaii to get the on the street, what's really happening, Anders. Good to see you. Hey, Anders, it's been probably a month or so since we've done this. What is the highest number that the 30-year fixed hit? Did we get to 8%?
We got a little bit under 8. I know I heard some people saying 8%. Of course, mortgage rates are all dependent on how much somebody puts as far as a down payment, their credit score, the occupancy. But when I'm looking at this, and you're looking at stats from Freddie Mac, we look at an owner occupant with a certain percent, like 20, 25% down. That was, it got up into close to 8%, but then it's come back down into the mid 7s right now. So, but it's still, it's still higher than I expected it to be at this time. But
I see. So right now, 30-year fix is approximately what?
It's about 7.25, 7 3/8.
7.25, 7 3/8,
Mhm.
and that's with like a point, 2
Yeah,
points,
it's about like a point. Yeah, it's a point.
about a point right now.
Yep.
Okay. And what
Yep.
about the adjustable rates? Where are those
They're
approximately?
about a 0.5% lower than that, but not much lower than the 30-year fixed.
I got you.
Several months ago, we were seeing a larger spread between the 30-year fixed and let's say a 5 or 7 or even a 10-year arm, but it's kind of compressed right now.
The last time you've seen, let's say, loan originations in your office this low, or as an industry, when do you think that was?
I mean, industry-wise, there is I just saw a stat that mortgage activity is back to the level that it was back in 1996. And that was a year when, I don't know if Paul has, well, you could look back at interest rates, but I remember that year, rates were getting close to 9%.
Mm,
Yeah,
wow.
yeah.
And I know you send Paul and I some market information each
Mhm.
week. What is the buzz inside the industry? Do you think rates are heading higher over the next 12 months? Lower,
I,
about the same?
I guess this is kind of and I don't know if this is just hopeful. We kind of were talking about, we think we're closer to the end of the tunnel than the beginning, which theoretically means that we feel like rates are going to come down in the next few months. But coming down to where we would just love to see it in the fives again at some
Right,
point.
yeah,
Yeah.
sure, wouldn't we all?
Yeah.
Anders, let me do a little speed round with you.
Sure. Sure.
And then, okay, we'll do a little speed round question. And
Uh-huh.
then I'd like to bring Paul back in and have the two of you kind of discuss. We've been talking about this risk
Oh, yeah.
premium
Mm-hmm.
of the rate, but let's take a look at that in a moment. Okay, but okay, Paul, you can stay on here. This is for Anders' speed
Uh-huh.
round.
Sure.
Okay, Anders, in the next 12 months, are rates going to be over 8%?
No.
Okay, you heard it here first.
Mm-hmm.
And the next 12 months going to be
Uh,
below 6%?
yes.
Wow.
Yes. Mm-hmm.
All right. Okay. And then final question, when are they going to be below 6%? Can you give us a date?
February 3rd next year.
Okay. All right.
Hey,
Okay.
again, these are just my personal opinions and nothing. Yeah, these are not from our company, but yeah, yeah.
Okay. We're going to fact check
Predictions.
that in February
Okay. Okay.
2024. All right.
Okay.
So Paul, thanks for coming back in. We've talked about this before. Generally, the 30-year fixed rate is going to track right above. Oh, you're pulling it up right now,
Yeah.
right? It's gonna track above the 10-year Treasury in a very specific band, and we have this big jump in that right now. Can you explain?
Yeah, you can see the history back to the moment that you and Anders were talking about in the 1990s, right? This is when the Fed raised rates in 1994, 95, this shaded yellow area. And there's that rate move. The overnight rate was increased, the long-term bond yields all jumped, and the 30-year bond yield, 30-year fixed rate mortgage rate jumped as well. But the gap between those two remained the same at about, in those days, about 150 basis points. The average for the last 20 years, 1992 to 2019, 17 years that I'm showing pre-pandemic, including these periods when the gap widened, the dot-com bubble, the financial crisis itself, some political upheaval around the federal budget and a government shutdown in 2011, including those elevated, although albeit temporary, intervals, maybe 170 basis points, 1.7 percentage points. So you would say with a 10-year Treasury note yield in equilibrium of something like a 4% number that we have now, that you'd see a 5.7% mortgage rate.
Mm-hmm.
The one Anders was suggesting we should have within the next 6 months if this spread narrows. The question really that's a quandary to some of us looking at this is, why has that spread emerged? We are not in a financial crisis. We're not in a pandemic moment, at least not the initial shock after the pandemic. So what is it in the financial system that's caused those mortgage rates to pull away from the risk-free rate. And shouldn't we expect, given that no recession has emerged, labor markets continue to be relatively tight at full employment, and uh, uh, given the expectation that the Fed has probably done all it's going to do, or is so close that it's not really worth arguing anymore, and we can anticipate lower rates over the next couple of years to accompany the lower inflation rates, why is it that the spread exists at all, and why wouldn't it dissipate
So
over the next
if
few years?
whatever that factor is goes away, whatever that is, if we want to call it a risk premium or whatever, even if the rates stay right where they are today, they should be about 1.5 low.
Lower. I think
Lower.
that's about right. Anders should hit his target by February, even if the 10-year Treasury note yield stays at 4%, 4.25, maybe 4.28, 4.29 this week.
Well, and let me ask you both. As far as this risk that's out there, we're calling it this risk premium. Is there any deterioration in the housing market? Are there foreclosures across the country? Is something happening that we're missing?
I'll let Anders comment a little more widely. I would say that to the extent, as an old recovering bank economist, that maybe there's something in the regional banking system, not so much the big money center banks, but in the kind of, the Silicon Valley space, in the 20 to $200 billion banks in America, whether it's exposure to commercial real estate risk that has yet to manifest significantly, or whether it's just the fact that banks in that space are holding on to a lot of 3% mortgages or mortgage-backed securities in an environment where the mortgage rate is higher. And if they had to mark to market, those securities would be underwater.
That'd be an issue. And Anders, you mentioned last time we spoke, the regional banks in Hawaii were tightening credit. They were maybe bumping rates, bumping things a little bit. Do you still see that tightening?
Maybe a little bit of that. But again, it's it's just there's less activity, right? There's less homes that are available to purchase. And going back to delinquencies or foreclosures, it's nothing's ticked up. So
if you think about it for a second, most people, a large portion of the home owning public has reset their debt to a 3% handle or something in that neighborhood, 3 or 4%. You have a big incentive to make your payment on time for the next 30 years or whatever it is, you know what I mean? And just sit there and enjoy the benefits of cheap finance. So I don't expect there to be any problems in residential lending per se, as long as nothing forces banks to have to shed those securities in their portfolio.
Right, and we have the liquidity that is different from the commercial market with Fannie Mae and Freddie Mac on the back end of this. Well, gentlemen, why don't we leave it there? We're going to take a quick break, come back, look at some housing statistics. And Anders, thank you very much for being on. It's really great to hear what's happening in your office. So we'll take just a quick break. Be right back with economist Paul Brewbaker.
Thanks.
Okay, and we're back. I'm Patrick ONeill from Luxury Homes International, and we're here with Hawaii's favorite economist, Paul Brewbaker. Paul, it's always great to have Anders. I know we talk about it all the time. If the two of you could, before we come back next time, can you figure out that spread component that the Fed doesn't know?
I will try. Yeah.
Yeah, it is. It's such an interesting point, because if nothing else happens, really, if that comes back into trend, we're right back where we need to be with interest rates.
True confessions. We've been saying the same thing for 6 months, and 6 months later, it's getting a little stale. Oh yeah, don't worry, the spread is going to disappear, and it's like, okay, it hasn't yet.
Well, just keep saying it; it'll come true one of these days. Okay, let's move on to the housing.
like the next recession.
Yeah, that's right. Okay, so this is the latest information from the Honolulu Board of Realtors, and kind of looks like the last ones as well. But I thought we'd start with closed sales. This is month over month. Home sales down about 20% compared to last year, 17% for condos. Now, the year-to-date figure, I think, is better. It's a bigger data set, down 32% for homes and almost down 32% for condos. And I just put these notes in the side. The last time we had an annual decline this big was in 1991 after the Japanese bubble period. I know it's completely different. Even if we look at 2008, after the subprime crisis, that was only a 24% decrease. This is a major decrease for the industry right now.
Well, think of it this way. How heavy an impact does a 4 percentage point increase in the mortgage rate have on sales volumes? The same as the implosion of a rational speculative bubble, the Japan bubble, and the subprime bubble. That's how much damage a 400 basis point increase in mortgage rates is doing, the equivalent of unraveling a bubble.
Right. And it's just been devastating throughout the industry. Well, let's continue on with the statistic. Active inventory, single family homes compared to last year is basically flat. Condos up 7%, which I thought was rather interesting. And then this has kind of been the story because we know everybody's locked in at these low mortgage rates. New listings down 13% for homes, down almost 10% for condos. And if we wrap up inventory against absorption rate and we get this month's supply of active inventory, both numbers are now approaching 3%. We had been in the single digits and just above it for so long. Possibly good news for buyers, do you think, as the inventory starts to build up a little bit?
Yeah, it's still 3 months is super. We were talking earlier about how back in 1994, 95, 96, maybe in that kind of time frame when the Fed raised rates and did not create a recession then, as hasn't happened now. At that time, it was 24, 25 months of inventory remaining. So 2 or maybe 3 months, call it 2 months going to 3 months in the last 12 months is nothing like 2 years of inventory,
Right.
which is what we saw in the mid 90s. But still, it's the movement that's important, and going from 2 to 3 months tells you something is bogging. It's something that's jamming
Right.
up.
Yeah,
the,
well,
the
pile up.
velocity. Yeah,
Yeah,
a little bit of a pileup there.
no doubt. And this is an interesting statistic, and I don't remember really ever tracking this before this last uprise in the market. But this month, 30% of homes sold at or above their list price. That compares to 53% last month. That is an interesting change. And for
Yes.
condos, 25% sold at or above list price, 47% sold at the same last month. There's definitely movement right now. I mean, we can feel it, right, in everything that's happening.
Which is entirely consistent. So you're talking about the premium, so to speak, right? How much above par are people, are people willing to pay to get the house? And that's starting to narrow somewhat.
Right. And coming out of what we came out of, everybody was just used to putting in offers at or above if you want something.
Well,
I
they're
see it
chasing each other's offers
chasing. Yeah, everything
at or
was
above.
above. And it was how
Yeah,
high above are
everything
you
was
going to
above.
go?
Yeah.
But I can see it even through our office now. Offers coming in below. There's negotiation again, which in some ways is a more balanced market and, might be something that's good in the long run.
Well, the concern in the short run is that we tip over the cup and the water starts running out where people are chasing prices down. We're not seeing that yet. It's remarkable how resilient prices are, which I think still speaks to an underlying scarcity of housing units, new and pre-owned.
Yeah, yeah. Okay. Well, Paul, let's jump over to pricing, as long as we're talking about the home market. And let me go back to the Honolulu Board of Realtors statistics, and we're going to take a look at pricing. So, median sales price, month over month, relatively flat, down 1.25 for homes, down.
Sorry, year over year.
Sorry, year over year.
Yeah.
Down 3% for
Right.
condos.
Yeah.
The better statistic, again, looking at year-to-date figures, not real significant. Down 5.7 for homes and down 1.6 condos. And interestingly enough, if you look at the box right next door, it's up 9.4 compared to 2 years ago, and up 8% for condos compared to 2 years ago. What do you think about the price trends? And we're looking at Oahu data. How does this relate to neighbor island data as well?
Yeah, you have to remember, comparing to a year ago is necessary because there's a lot of seasonal movement in prices. So prices in the summer tend to be higher, and then they wane a little bit. Fall is a somewhat less robust season from a transaction standpoint, or the robustness of demand. So I adjust for seasonality to the extent I can, which is why some of these images I get might seem to contradict or conflict, at least, with the data that are published. So let's walk through that and pick out a couple trends. These are Kona Kohala prices. So tax map keys 5, 6, 7, and 8 on the west side of Big Island of Hawaii, from North Kohala all the way down to South Kona District. Yeah. And history, much like you see across the islands, with a significant rise after the pandemic in both condo and single family home prices. And you would say there, on a seasonally adjusted basis, the prices are at or slightly below a year ago, but of course significantly higher than they were 3 years ago. And more importantly, I think for the purpose here, in both cases, significantly above historical trends, if you will. If you think of these surges as in some sense temporary. Konokohala, we have Maui data, again, the same profile as surge, above the underlying trend, a very, very stable trend, I might add, in the late 20 teens. So definitely something that's been unleashed by the pandemic. And again, something affecting both single family and condo markets. And here in close up, you can see, I mean, can you imagine a median condo price of 800,000? That's what Maui has now. Well, my guess is it has something to do with the post-pandemic remote work phenomenon. It is distinct from Oahu, where condos have not experienced the same surge. Maui, where the condos are mostly in resort areas. Honolulu, where the condos are mostly in the urban core. They're residential condos as opposed to resort condos. Both markets see this single family surge. And in addition, on a seasonally adjusted basis, and this is why it's challenging to look at year over year measures, because yes, August 2023 may be at or around or slightly below August 2022, but we've had this interim dip into the winter months adjusted for seasonality, right? So here's January, and then February, March, April, May, June, July, August. We've been zigging, zagging up in the single family market. I think that's really significant, and just something worth paying attention to. Why aren't condos responding the way on Oahu, the way they have on the neighbor islands, or at least these two important submarkets? The work from home phenomenon in Honolulu has shifted housing demand away from the urban core to the suburbs. The neighbor islands are sort of ex-urban and even, Zoom town destinations for vagabond workers, people who have just left the mainland and bought a condo in a resort area, and can work remotely from Maui or from West Hawaii
Yeah.
Island.
No, it's very interesting to see the difference in the trend lines. And I think what you're touching on is exactly that. And
Here as just another reminder, these trends are remarkably similar in terms of the rates of increase. So you're looking at maybe 5.5% appreciation for West Hawaii Island. For Maui, here's Maui, here's West Hawaii, 4.5 to 5, 5.5 to 6, and on Oahu something more like 4 to 4.5. I
yeah,
mean, they're close enough. You'd expect a little more rapid appreciation over time in neighbor island markets that are sort of catching up. So sort of Oahu, bright lights
Right.
and, bright city lights back in the early statehood era, and then more in the more recent quarter century, the neighbor islands have sort of caught up. Single family home prices, Kona Kohala today, median single family home prices are the same as they are on Oahu.
Yeah, it looks like the anomaly in all of that are the condos on
Yes.
Oahu. Everyone else has trended up in
Yeah.
very similar fashion. So,
Yeah.
very interesting. Okay, well, Paul, let's take a super quick break. We're going to come back. It's going to be the lightning round. Points are worth double. Okay, so stand by. We're going to be right back with economist Paul Brewbaker. Okay, and we're back with economist Paul Brewbaker. By the way, if you enjoy the material today, please give Paul a thumbs up down below and hit the subscribe button. He'd really appreciate it. Okay, Paul, time for the bonus round, double points. Okay. Okay, first question. Are interest rates going to go over 8% in the next year?
Which ones? No.
Next 12 months? No.
Yeah, no,
Okay.
no.
Okay. Will interest rates go below 6% in the next 12 months?
Well, of course, treasury yields already are, but mortgage rates in the next 12 months, yes, will be under 6%.
Oh, wow. Okay. 12 months from now, single family home on Oahu, higher, lower, about the same in price?
About the same as about the same.
Okay.
It's
All right.
it went high and it came back down and it's been coming up, but I think we're kind of we're
About the same.
in one of these oscillatory sideways kind of phases, I think.
Okay. All right. How about Oahu condos pricing 12 months from now? Higher, lower, about the same?
Oh, I think they'll drift higher. I think they're in a catch-up position right now. They're kind of out of sync. They're like too low.
I like that. Okay. All right. We'll check with the judges. I'll get back to you on that, but it sounded like you did well. So, uh, hey, Paul, it is always such a pleasure. Truly enjoy the time we get to spend here today. And for everybody that's watching, I hope you enjoyed this. And be well, be safe, and we'll see you next time. Aloha.
Thank you, Patrick.